Anyway, so welcome everybody. Mark Whistler here. We couldn't have a better day for a webinar on chop trading because that's exactly what's happening this morning. And if anybody here, if you've had a little bit of trouble, obviously, there we go. If you've had a little trouble with obviously being shaken out of positions, with not being able to exactly hold positions for a long period of time, or just in the recent market, if there's just so much uncertainty, it just seems like there's just almost no way to really be able to predict a longer term trend other than last week. There was some really nice trending last week, don't get me wrong, but if basically after these periods of trending occur, you find all of a sudden you're just getting basically killed within markets. And this webinar is for you because at the end of the day, weeks like last week where we saw, and I'm just going to zoom out here a little. I know this chart, you won't be able to see the bars exactly, but if you look at my chart here, you can see we had this nice big drop off. Well, here's the thing. It's pretty easy to make money in this type of a market. It's, anytime that we're seeing a big trending market, just about anybody can make money because it's really not that complicated. You can see right here we have a nice trending market. All you really have to do is look for a pullback to a main moving average, or really kind of just as long as you're trading with the trend will eventually bail you out. Even if you would purchase, in the case of the U.S. dollar Swiss franc here, even if you'd bought the U.S. dollar Swiss franc up high, as long as you had bought it and were trading with the trend would bail you out. That's the old cliche, the trend is your friend. However, the problem is that when markets stop trending and start trending laterally, that's where most traders start to get killed. And they, not only that, but usually if they've just come off a big win, obviously from the recent occurrence of trending, they want to keep trading, and they're so excited about it because all of a sudden they book some big profits, and they want to keep trading, so they start over trading, and then because markets are moving laterally, they get killed. And again, part of the issue there is because they're constantly looking for the trending breakout. They want to trade with the trend, or maybe they have the good old problem of always looking for a big reversal. But regardless of which end of the stick you lie on there, the issue is that we're in a lateral choppy market, and unless we trade a lateral choppy market, all of our positions are going to end up losing. So what we need to do is we need to be able to recognize when these lateral choppy markets ensue. We need to be able to identify ahead of time when they're about to kick off, when trending has ceased, and we need to be able to understand how to trade these lateral choppy markets. And that's what this webinar is for today. And also it's important to note that what we're going to do is we're going to pick up the second half of this webinar on Friday. I think, Maud, is that for your subscribers? So that's going to be advanced strategies for lateral trending markets. So I'm not sure if that's open or for the premium guys for FX Street, but that should be a great webinar as well because we'll build on everything we talk about today. But hopefully within the next 49 minutes that we have left, we'll be able to get through a lot of this information. So anyway, what I'm going to do is I'm going to just back up here for a minute. And what we're going to do here is we're just going to talk about some basic principles about volatility and probability. And first and foremost, I'm just going to show you my settings, and then I'm going to explain to you why I'm using these settings within this chart and how that could potentially help you, obviously, with volatility and probability. And what I'm going to do here is I have set two sets of Bollinger Bands, which actually I call volatility bands because I think that just about everything in the market that has been named incorrectly keeps traders from accurately seeing what's happening, not only within markets, but also understanding the information that surfaces within markets on a day-to-day basis as well. And volatility bands or standard deviation bands are exactly that. They're measurements of volatility and standard deviation. And you can see what I've done here is I've put in two sets of bands. One set is a 14 period, this is the black band, is a 14 period at 3.2 standard deviations. Then in red, we have a 34 period at 3.2 standard deviations as well. Hope everybody sees that. I'm going to click on OK. So again, red bands are 34 period at 3.2 standard deviations, while our black bands are 14 period at 3.2 standard deviations here. And actually, you know what I'm going to do? So I'm going to make one last adjustment here. I'm trying to think of I use so many different settings on a day-to-day basis. I'm trying to find a setting that will actually be perfect for you guys, so you won't have any issues in understanding kind of what's happening here. So what I've done is I've just changed the setting of the red bands here from 34 to 1.25 standard deviations. That's a low standard deviation. Not very many people use that standard deviation. Well, there's a reason for that, and because a lot of the information that makes the markets is flawed and broken and incorrect, and those people don't understand what they're looking at in the first place. So I think when I explain to you why we're using 1.25 standard deviation, you're gonna be like, wow, that's incredible. I never realized that was so powerful. Because what most people think that Bollinger Bands are measurements of standard deviation, they think the second you hit a Bollinger Band that you're supposed to see a reversal. And of course, the market tells us that as soon as we start to tack a Bollinger Band, we're starting to see an overbought or oversold situation. Well, that information is absolutely 100% dead wrong, absolutely wrong. What it means is subset distribution on the move. Like if you were trying to get out of a potato sack, if you were locked in a potato sack, the first thing you would do is start pushing on the outliers, pushing on the outside. And if you were looking at that potato sack from the outside, like somebody who was stuck on the inside, you would see that they were pushing on it to try and get out. Well, that's exactly what price does when it's attempting to move. It pushes, it pushes, it pushes. That's telling you empirically that you're about to see an example or a moment of subset distribution on the move, not that price is overbought and oversold. By the way, the words and the terms overbought and oversold are a complete joke. They mean nothing. And the only people who use the terms overbought and oversold are people who do not trade with real money. Because what is overbought? It's nothing. It's a generalized term of nothingness. Overbought can be anything, and oversold can be anything. And so when you hear people talk about indicators or oscillators that are overbought or oversold, it's because they really don't understand what the indicator oscillator is telling you. And I'll show you a perfect example of that really quickly here. You'll see we have two CCIs in this window here, and what you're going to notice is that in terms of CCI, we're commonly taught that a move above positive 100 is overbought, and a move above or below negative 100 is oversold, right? That's just the way it is. That's what you hear. Well, you'll notice something amazing here. The entire time that we saw this big trending move kick off, we traded above, or we kicked off above on a 14-period basis. You can see I have in blue, I have a 14 period. In red, I have a 200 period. 14 period, 200 period. Why am I doing that? 14 period is for short-term trading action. 200 period is for a gauge of trend. And you can see when we kicked off this trending move, our 14 period traded above positive 100. Does everybody see that nice and clearly? You should. And so obviously when this was the overbought situation that you're normally taught, then all of a sudden when we failed back below 100, notice price kept going upward. Why is that? Because it was a subset distribution on the move. It was never overbought or oversold. Those terms are a joke, and the only people who use them are people who don't trade with real money because they don't know what they're talking about. Because if you're trading above 100, it means you're trading above the first standard deviation. And a move outside of the first standard deviation of a distribution means subset distribution on the move. Now notice something even more amazing. I'm going to take right here, and I'm going to make my red distribution a 50 period distribution. So I have a 50 period CCI up here. Does everybody see that in red? In fact, I'll make that line just a little bit bigger so we can see it nice and clearly. Everybody sees the 50 period here, and we start moving up and we travel above 100. You're traditionally taught this is overbought. Well, check it out. See, the thing is all of the definitions for CCI are incorrect as well. Because if you go ahead and you read a definition, even in MetaTrader, even anywhere, it'll tell you that CCI is normal deviation from the general range, generally meant to measure cyclical movement. What a joke that is. What it is it's mean absolute deviation. Mean absolute deviation is different than standard deviation, or normal deviation, which is a synonym of standard deviation. What mean absolute deviation is it's utilizing the Chebyshev theorem that attempts to basically quantify that approximately 75% of the data should lie within about 1.25 standard deviations of the mean. And you can see here what I've done. This blue line right here, notice this is a 50-period Bollinger Band set at 1.25 standard deviations. Now look at this amazing occurrence happen. When 50-period CCI moves above 100, price crosses above that 1.25 standard deviation at the exact same time. And then you can see as we start traveling upward, the second that price kind of comes back below that 1.25 standard deviation, again, we're on a 30-minute basis here. Look at what happens. Our CCI comes back below 100. Okay, so the reason why I'm going over all of that is because I want you to understand that all of the information that you're generally taught with the market is absolutely wrong. People who are telling you overbought or oversold don't know what they're talking about. They likely don't trade with real money in real time. I know that there's a couple of people on FX Street. If I'm right, Maud, I think, is it Sam who talks about CCI? He does a wonderful job, I think, and he's a really, really incredible trader. By the way, I would listen to his conversations on CCI. I hope I have his name right. I think he's a really, really great trader, and seems like just a heck of a nice guy too. But he understands the cyclical nature of CCI. So if you're for a greater briefing of CCI, I think I would probably maybe listen to his webinars. Because we're not going to go into it too much more extensively here. I just wanted you to see the basic circumstance of what CCI is, because really it's just a measurement of 1.25 standard deviations from either side of the mean, at positive 100 or negative 100. So again, I think for greater guidance, I would go perhaps listen to his webinar, because I think he really focuses on that, and he just does an incredible job, and I think he's probably a really incredible trader as well. So. But anyway, so you can see right here where we start to break above 100 here. Look, exactly. This is not overbought yet. We're not overbought. This is a subset distribution on the move. Does everybody see that? Well, here's the thing. Is anybody can trade this, right? Because all you have to do is basically take a position with the trend, and you're going to do okay. Well, how do you trade this chop? How do you know when this is about to take place? How do you trade this? Any thoughts? Okay, and I just want to make sure everybody can see my chart, okay? Yeah. Okay, now we're going to get into some pretty neat stuff. And what I need to do is just back up just a little bit here. What I'm going to do here is I'm going to save two charts, and then we're going to basically drop these into just a little bit of a different format, because I think sometimes when we just change the way that we look at what's happening, and then move to break even. Okay, I'm not sure if I understand your question. Yeah, well, pit magnet, I like the way you're thinking already, and it's obvious. I mean, that's great. You're like looking for the potential move here, which is great. Well, let me just go over some of the information here before we get too far. And I'm going to just close down the screen sharing for just a moment while I change screens. And okay, now can everybody see my screen here? You should be able to see it just fine, I think. Yeah. Everybody can see the, okay, great. Now, what happens if I just do something just a little bit different? What if I change the way that you view the data? because that's really all this is this is data. That's it. It's no more, it's no less. This is just data. And that's what's so amazing about it. And what I've done here is I've just basically changed the chart, the way it's presented. And instead of seeing it in a normal up and down presentation, what you're actually looking at here is it's sort of like a roadmap. And what you'll notice here is that in a situation of trending, the road is clearly just kind of moving to the left here. Well, first and foremost, this is just a common sense basis and really doesn't have a lot to do with our webinar, but I'm going to mention it anyway, just because I think it's so important for all retail traders. If the road was going to the left, why the heck would you ever try and turn to the right if you were driving? Just out of curiosity. If the road was so clearly going to the left, why would you ever try and turn to the right? Why do retail traders try and do that all day long? What is the matter with them that they're always trying to drive off the road? For the life of me, I just can't understand it. I've spent years trying to understand the reversal mentality of retail traders. That's neither here nor there. But anyway, okay, what we're going to do here is I'm going to show you in terms of a distribution, because that's really what we're looking at. You can see the lines that I've drawn here are, let me just back up a little bit. The lines that I've drawn here in black are measurements of a distribution. These are, people, I think we don't understand what the market is really showing us. And you can see here that if I were to just actually draw out the actual distribution of the data that we're seeing here, and it doesn't matter whether, all the arguments of, is the data random, all that stuff, it doesn't matter. It's like a moot point. It's like arguing, it's arguing whether cattle walk on all 4 feet in terms of shipbuilding. It's something that is so irrelevant it doesn't even matter, because all you have to do is just look at the data and you can see that the distribution, the width of the distribution constantly expands and contracts, right? Why is that? It's because of the squaring. Oh yeah, by the way, Tom, I did do it when I first started out. I traded against the trend because that's the way it is. That's what everybody does. It just is part of the game. Everybody wants to be smarter than markets. Everybody wants they want the big win. They, believe that the trend can't go forever. It's almost too easy to make money. So we all, it just is what it is. But, after a while, once you eventually just get tired of getting beat up or burn out, and you start getting smart, start trading with the trend, and you start to make money. But anyway, you can see in terms of the actual distribution here, the distribution collapses. And not only that, it expands as well. Does everybody see that? It should be clear as day here. Why is that? It's because of the squaring of the exponent in the formula of standard deviation that creates a multiplier effect. And the multiplier effect actually creates this expansion and then this compression. This expansion and this compression. Well, here's the amazing thing about volatility and probability. Did you know that there's a 99.7% probability that all of the data will lie within 3 standard deviations of the mean? Let me run through all the probabilities with you really quick. First and foremost, there's about approximately 68% probability all of the data will lie within 1 standard deviation of the mean. There's a 95% probability all of the data will lie within 2 standard deviations of the mean, and a 99.7% probability, we'll just round that down to 99, but 99% probability that all the data will lie within 3 standard deviations of the mean. And in the black lines here, I'm measuring 3 standard deviations of the mean. Well, here's the thing. In terms of the probabilities I was just talking about, how much of this data is outside of 3 standard deviations of the mean? Like none. Why is that? Here's the thing, is that because of the squaring of the exponent in the formula for standard deviation, and because the mean itself is mobile, the way all of this data is translated electronically, it means that it's virtually impossible to have a 4th and a 5th standard deviation outlier, because the wings of the distribution are expanding at the same time price is moving. That means that when volatility kicks up, because of the squaring of the exponent in the formula for standard deviation, when volatility kicks up, your measurements of standard deviation will automatically fire outward, alerting you that volatility or trending is about to kick off. Does everybody see that? Here's what's even more amazing. This should be, I think, one of a pretty eye-opening experience for everybody here, because this information is not available in normal markets. Because all of the stuff that you're given is built for failure. All of it, including, I can tell you mathematically why the formula for stochastics is flawed, why momentum, the indicator, is hard-coded incorrectly, all of that. So you can see here that basically, all I have to understand is that when volatility begins to expand, and I'm drawing the lower blue line off the chart here, when volatility begins to expand, trending kicks off. But then when volatility compresses, notice that my volatility band's here. This is the volatility band here. Notice when volatility begins to compress, you can see it over here too. When volatility begins to compress, prices move what? Precisely laterally. Volatility expands, prices trend. Volatility compresses, prices move precisely laterally. Volatility expands, prices trend. Volatility compresses, prices move directly laterally. What this begins to tell us is we can start to watch short and long-term volatility for moments of expansion and compression. We can start to look for expansion to have some indication about when trending is about to kick off, and then we can look at compression to start to look for moments when lateral trading is about to ensue. Well, here's where all of this gets even more amazing. And again, this is information that just it never makes it to the retail trader, because all the stuff that you read from most media, those people don't trade with real money. Even all the many of the information sites out there, the people who are putting that information out don't trade with real money. Why would they even need to bother with the truth? All they have to do is keep regurgitating this broken theory. And because everybody just buys into it, they stay in business. But the fact is that once their own money is on the line and they start losing every day, they've got to start finding real information. And so what you're going to notice here is, and I want to talk about this in theory here really quick. If I'm measuring, and you can see, again, what I'm measuring is 34 periods of data here. And say if I'm measuring 34 periods of data, and then I'm measuring 50 periods of data, let's just say this theoretically, which one of these two distributions, and we'll just assume that these are actually both distributions, and I'll draw them out so you can just see it right here. If I were to draw two sets of distributions here, let's see, there's a 34 period distribution and a 50 period distribution. Which distribution should, in theory, which distribution in theory should basically have a wider wingspan, the 34 period or the 50 period? Which distribution should be wider? Who can answer that really quickly? Tom, you're right on the money. Is that Tom Strom, by the way? Tom Strom is a great trader who attends today's Tom Strom. 50 period, right? But why? Why should the 50 period be wider? We always ask why about everything. Why, Mark? Why? Tell us why. More data. Right, Tom, you're exactly right too. More time equals more data. And Phantom FX, you're totally right on the money too. It's because it measures a bigger move. You have a higher probability or a greater probability of higher highs and lower lows in 50 periods than you do in a 34 period. And the reason is because you're measuring 14 periods more data. If you have 14 minutes, and we'll just, basically imagine if you were running upstairs in a building, you obviously could run up more stairs in 50 minutes than you could in 34, right? More than likely. And every once in a while you'll exert yourself harder in the 34 periods or 34 minutes and maybe do so, but if you were to do that every day for a year, the data would eventually show that you were able to run more stairs in 50 minutes than 34 because you just had more time, right? So here's the thing, is that when all things are normal and relative within markets, when everything is perfectly calm and prices are moving directly laterally within markets, guess what? The shorter term distribution, in the case of what we've drawn here, is a 34 period distribution, and then we have a 50 period distribution. But keep in mind, the 34 period is measuring 3.2 standard deviations, and the 50 period here is even measuring 1.25 standard deviations. When all things are totally normal and calm within markets, I have a 34 period at 1.25 and a 14 period at 3.2. When all things are totally normal and calm, in fact, you know what I'll do? I'll label these for you guys just so you can see them. And in blue here we have also, so we have a 50 period at 1.25. Standard deviation, and right here we have a 34 period at 1.25, and right here we have a 14 period. Hopefully that helps. And that's at 3.2 standard deviations. Cool? Everybody's cool with that? Great. Okay, so here's the amazing thing. When all things are normal in market, when there is no pressure, when everything is in a natural state, even in terms of statistics, when there's no push or there's no pressure on the outliers of the distribution, when the subset distribution is not on the move, all things should move directly laterally. That's what most traders, I think, also fail to understand. The instance of lateral trading really means that markets are returning to a sense of parity. Maybe not parity in valuation, but parity in terms of of not having the outliers of pressure on the distributions causing subset distributions to move. But when we have this instance of markets returning to perfect normality, here's the amazing thing. Notice that our 3.2 14-period standard deviations collapse inside of the 34 period 1.25 standard deviation. Notice here they come very, very close, but we're just in a period of collapsing. And here we collapse all the way back inside. Well, what do we know? When our shorter term volatility, which will spike quicker than our longer term volatility because there's less data to measure, because obviously if I were to push on the outliers of a 14-period distribution because I'm measuring less data, it would spike much quicker than that 50 period because the average weights down the ability for those outliers of the distribution to move very, very quickly. But just so you understand why the 14 period spikes quicker than the 50 period here. If all things return to normal and you see the 14 period collapse below the 34 period 1.25 or even the 50 period 1.25, what does that mean to us? It means get ready, because energy is stored and a trend is about to start to rip. But when we see these periods of volatility collapsing, we know that markets are going to move directly lateral. Well, if the road is driving directly straight, why would you always try to turn? That's the thing. What we do want to do is we want to recognize, obviously, the longer term trend. Okay, so now what I'm going to do is I'm going to jump over to another chart here. And look at that. We've got a perfect instance of chop trading. What we'll do is we'll just change this guy over here. And you'll notice that immediately there's a couple things that we'll want to take a peek at. First and foremost, that when chop trading begins, you're going to notice that that our 34 period 1.25 standard deviation, the 34 period 1.25 standard deviations begin trading almost directly on the 50 period 1.25 standard deviation. Does everybody see that? If you have your 34 period 1.25 standard deviation trading exactly on your 34 period 1.25, it means that basically you're not seeing an instance of trend, because the 34 period, the shorter term distribution, will move to the right quicker. We're going to break down than the longer period, or it will move to the left quicker than the longer period distribution if we're going to break out. And the other thing is too is that you'll see in terms of volatility here, what's amazing is that there's no expansion of our volatility bands. You can see there's a nice defined kind of range that correctly, by the way, this is the lateral move directly after that period of trending we just looked at. And you can see something else that happens here too. If we actually take a look at our CCI here, you'll notice if I were to mark off CCI here, the actual instance of, let me actually, if I were to mark this off here, you'll notice that period of negative 100 to positive 100, that CCI is really trading exactly in that area for the bulk of our time of consolidation, of lateral trending. Does everybody see that? And because volatility is not expanding, and because our short-term volatility is not spiking outside of longer-term volatility here, it means that then I can start to use CCI on a longer and or short-term basis to be able to trade in a lateral market with what is called the containment zone. Well, what is the containment zone? This area of red that you see here on CCI is actually the containment zone. Yeah, you bet. We sure can, Hardy Stacks, but what you have to understand is that you're looking at a dollar pair right now. You're looking at US dollar Swiss franc, right? So, and actually, this is almost real time up here. So just FYI, that's exactly what we're doing, Hardy Stacks. Perhaps you would like me to just put this in a nice little cookbook for you and a nice little formula, so you wouldn't actually have to listen to any of the information, take in any of the data, or actually think about it. I can do that for you if you'd like. That would be just nice and brainless. That way nobody would have to take any time to think about what they're looking at. But anyway, what we have here is 1.25 standard deviation containment zone. And what that containment zone is, again, in terms of CCI, is exactly the instance of 100 to, is exactly 100 to, or excuse me, 1.25 standard deviation to 1.25 standard deviation. And let me just pull this guy up here. We have, you can see right here, if I were to mark this off, change the color on that. And yeah, we'll hustle here in a moment and get away from this stuff and actually go look at our charts, because I do want you to see it, you know, exactly what's happening here. But it's important that you understand the theory first of all. Notice that this containment zone gets smaller and smaller and smaller. Well, here's the thing, is because as lateral chop trading ensues, your containment zone will compress. You'll start to see consolidation. So what we're talking about is basically is a situation where even though when you look at CCI, this is why CCI really tends to fail the regular trader, just in terms of when we're trying to trade it in lateral chop zone, because it doesn't measure consolidation really. Because you can see that basically you have this consolidation in the 1.25 standard deviation here. Does everybody see that? But then basically at the same time, your CCI, because you have hard lines of measuring the 1.25 standard deviation, and I mean hard lines in terms of horizontal lines. Those horizontal lines of that 1.25 standard deviation are not going to expand and compress. So what we have to understand is sometimes when we're looking at CCI, we will be misled by the information, especially in a lateral chop trading market. And the reason for that, yeah, John, so I'm assuming you missed the first part of the webinar, because you'll notice that exactly at the precise same point, because I already covered all of this, but we'll just stop the webinar to go over that really quickly. You'll notice at the exact same point here that that CCI right here moves above negative 100 is the exact same place where price moves above 1.25 standard deviations. Because CCI is calculated using mean absolute deviation, not normal deviation, not standard deviation, mean absolute deviation, which means we have to expand our actual standard deviation on a chart to be able to see it. Notice you'll see it right here too. Everybody sees in this instance where CCI starts to move back above negative 100. It's exactly where price moves precisely above 1.25 standard deviation. This is called the containment zone. The containment zone is the main belly of data. And when price PIP-FX already, or PIP magnet, or no, phantom FX, somebody said it, I can't remember. When price begins to move outside of the 1.25 standard deviation, and you have an empirical example, an instance of short-term volatility expanding, then trending kicks off. But if you do not have any actual vertical, or any trending type movement of short-term volatility or long-term volatility, and you can see our shorter-term volatility in terms of the 14-period 3.2 standard deviation, everything moves laterally here. You're going to see precisely lateral trading, which means all you have to do is understand that we're going to trade in and out of that containment zone, that 1.25 standard deviation. Does everybody see that? Okay, so in the current market right now, I know a couple things. One, I basically know that I have sort of my this US dollar Swiss franc here that we're looking at. I basically have my indications of lateral trading here, and I can see that volatility is still moving laterally. We can see that our 34 period. Remember, we have our 34 period 1.25 standard deviation, and of course our 50 period 1.25 standard deviation. We're still not seeing any expansion or instance of trend in these two main measurements of the belly of data, which is 1.25 standard deviations of the data, or we know there's a 68% probability all the data will lie within two standard deviations, or one standard deviation of the mean. So what I know here is that I don't really want to do anything right here. Why is that? Because we're sitting right on the mean. We're sitting in no man's land. And so what I want to look for here is, I know we're moving in a directly lateral market. I want to look for just a little pop above our containment zone, and then like a bowling ball rolling on a teeter-totter. Imagine the mean is the center of the teeter-totter, and then you have one standard deviation, two standard deviations, and three standard deviations. I know those third standard deviations are going to contain all of the movement of the bowling ball. And the teeter-totter moves, though. If I were to roll out and touch the very tip of that teeter-totter, the bowling ball would have to roll back a little bit before rolling back out again, and the whole teeter-totter would move, right? But if the teeter-totter isn't moving, and you can see that in the exact empirical instance of our means moving directly laterally here, if the teeter-totter is not moving, and I know that there is no pending economic news that is about to move markets significantly coming out in the next 15 to 30 minutes, and we were to trade just slightly above that 1.25 standard deviation containment zone, a drop back in, a slight failure of that 1.25 standard deviation would be a one mean reversion position, A, and B, a nice place to take a lateral chop market trade. And it is not until short-term volatility begins to expand outside of long-term volatility, meaning that both the short-term 1.25 standard deviations here begin to spike outside of the 50 period 1.25 standard deviations, and or my 14 period 3.2 standard deviations begin to spike out of their normal relative range, that trending will kick off. So while I can watch volatility, short-term volatility, and then both short-term on a 14 period 3.2 standard deviation basis, and then also short-term volatility of a 34 period 1.25 standard deviation inside of the 50 period 1.25 standard deviation, I can simply just watch volatility to try and attempt to identify the precise exact instance of when trending is about to kick off or lateral trading is simply going to ensue. Well, here's the thing about volatility is that even if I were to go down into basically my shorter term time frame, and I'll just show you if we're going to look at the hourly chart here. You can see that in an hourly chart, that 34 period distribution has now fallen perfectly inside of the 50 period distribution. The longer this takes place, the more the distribution is storing energy and getting ready to break out. But after an initial move, the second you see that shorter term volatility collapsing in this lateral market, you should get ready just to trade the containment zone. And the containment zone is easily identifiable on that 30-minute chart, where you can see that a move above the containment zone means mean regression. Move below the containment zone means mean regression. Move above the containment zone means mean regression. Move below the containment zone alludes to mean regression. Move above the containment zone alludes directly to mean regression. A move below the containment zone alludes directly to mean regression. And that's exactly where we're sitting at. And it happens time and time and time again. And the reason why it empirically surfaces over and over and over is because when all things are relative and stable within markets, the shorter term distribution will fall back inside of the longer term distribution, exactly what I showed you before. And then when trending kicks off, and you can see it exactly right here, the same thing, exact same thing. When trending kicks off, short-term volatility spikes outside of long-term volatility, alerting you to the fact that subset distribution is on the move. So as we can see in the current market, we're starting to fail right here. As we start to fail right here, I could very possibly take a position into the lower part of the containment zone here, but it would be a slightly risky trade because I'm taking a position directly on the mean. If I want to trade the highest probability lateral chop move trade, I'm going to wait until we're trading just barely above that first standard deviation. Only if my short-term volatility is still resting inside of long-term volatility, not spiking outside. And then we begin to fail that containment zone again. Then I trade mean regression. I trade mean regression. I trade mean regression until short-term volatility begins to spike outside of long-term volatility. Well, of course, I know that anytime we're going to see any little bit of trending on a shorter-term time period, like a flight chart, we're going to see instances of a short-term volatility beginning to spike outside of long-term volatility. Does everybody see short-term volatility spiking here? Well, why is that on the 30-minute chart we're not seeing that short-term volatility spike outside of long-term volatility, but we are on the 5-minute chart? Of course, absolutely, because we're just measuring last data. So you can see right here we're starting to fail outside of the short-term the 1.25 standard deviation on the 50-period distribution on a 5-minute basis, which would start to indicate the possibility of a subset distribution on the move. But that subset distribution on the move on a 5-minute basis is still just in the regular range of the lateral chop zone of the 30-minute chart. So I know if we continue to fail here, the target I would be looking for, first target in the lateral chop trading zone, is right into the 1.0386 area and really down in the 1.0374 area, where we'll likely just turn back up and buck upward. And you can see that you'll see the exact instance of the subset distribution beginning to fail. Well, if we start to move back above 1.0402 here, which is incidentally the whole number as well, if we start to move back above this level, then basically we should actually retrace not only the mean, but attack the other side of the containment zone. So what I'm going to do is I'm going to do nothing here for 1 minute. I'm going to sit on my hands, because I know that basically if we are going to see a subset distribution on the move on a short-term basis, then I'm going to have a first profit target at 1.0374 and a second profit target at 1.0360. But I'm not fully convinced that this is a subset distribution on the move yet, because of several reasons. One, obviously I want to wait for this 5-minute bar to open, and I want to see the next bar ensue. A and B, you can see that we're sitting right on support, and C, we're sitting right on the whole number, which is all common sense outliers. And here's the other thing too. In terms of that 1.25 standard deviation, look, exactly where we start to fail negative 100, where you're taught that this is oversold, is precisely the place where we're failing that 1.25 standard deviation containment zone. So whoever's using the term oversold down here is an idiot, because oversold means nothing. It means, like, basically it's like saying, hey, what's the weather going to be like this week? And you say, it's going to be like weather. What the heck does that do for you? It does nothing. Of course there's going to be weather, but you don't know whether it's going to be up or down. That's what overbought and oversold is. It just is like this amazingly loose, just undescriptive term that is a joke, and I encourage everybody here to stop using it. When we start to fail negative 100 on TCI, it means subset distribution is starting to move outside of the first standard deviation of the containment zone. So if we start to, I'm going to wait for, there's 1 more minute left in this bar, and by the way, I have to wrap up in about 1 minute, everybody. But if we start to fail this, we close here in 60 seconds, and then we start to fail again, and you can see short-term volatility is now expanding. Everybody can see that here. Then I can simply just watch volatility as my guidance. And if I see short-term volatility right here begin to fail outward, I'm going to have a leading indicator of subset distribution on the move for a short, quick-term chop trade downward, where then I'm going to want to start to look for a reversal back up in the range. And here's the thing. Is the problem with stochastics, with MACD, with ATR, with Ikimoku, whatever that junk is, with all that stuff, I challenge, even Fibonacci, I challenge anybody here, give me one single empirical reason why it should work tomorrow over yesterday, other than the fact that it did work yesterday. What I'm saying is justify it mathematically why it should work tomorrow over yesterday, other than the fact that you just observed it working yesterday. And the problem is nobody has any empirical answers. That's how I do not trade. I do not trade with junk that provides no empiricism of why it should work tomorrow over yesterday, other than the fact that it did just work yesterday. Because there's no reason it should really work tomorrow, unless enough people hopefully keep doing the same thing. But when they stop, you're in big trouble. And I don't want to be on that side of the market. I know, because of the expanding and compressing effect of standard deviations in the measurement of subset distributions, because of the squaring of the exponent in the multiplier effect within the formula of standard deviation, that there's a 99.7% probability all of the data will lie within 3 standard deviations of the mean, 1 and 2. I know that when all things are relative within markets, short-term volatility should rest within long-term volatility, and when trending is about to kick off, short-term volatility will spike outside. What it means is I actually have an empirically provable moment of probability to understand why what's going to happen tomorrow should happen tomorrow, other than the fact that it just did happen yesterday. I have something mathematically provable. No more hope. No more relying on bogus patterns that fail for almost no reason sometimes. You're left scratching your head. No more standing around going, I just don't understand the volatility. It's time just to use pure empiricism, pure math, and to put trading back on your side. Again, everybody, this is Mark Whistler with Wall Street Rockstar. I hope that you enjoyed today's webinar. And again, we'll do an advanced session for this same strategy on Friday. You can visit me at wallstreetrockstar.com. Thank you so much, Maud. And thank you so much, Adinda, and everybody else. I think you guys probably have another incredible guest after me. Jerry first, yeah, who's a great trader and a great analyst. So please give Jerry your greatest ear and all of your respect. And I look forward to chatting with everybody again very soon. So please have a wonderful, incredible day. Thank you.